Hi there, folks. This is Mitch Firestone with Precision Trading Labs in New York City. It is March 1st, 2024, and I am here to bring you a quick market wrap-up for the week that just ended today, as well as to talk about some upcoming trading levels for the week of March 4th, 2024. And for that, we'll look at the SPY and the Qs, as well as some popular individual stocks. So before we get to that, the usual disclaimer, everything that we do here at Precision Trading Labs is for educational and informational purposes only. We're not money managers, nor are we financial advisors. However, we do have numerous subscribers, and what we do is help them to become confident, competent traders. So let's take a look at some of the levels here. So here's the chart of the SPY. Of course, the SPY is the ETF of the S&P 500. We're looking at a 2-hour chart here at the moment. Generally, I'm looking at particularly for swing trading purposes, generally looking at the daily chart as well as the kind of 1 and 2 hour chart, which basically just more or less helps to refine the daily. So anyway, this is what we're looking at here. We're actually sitting right now at an all-time high. Today we hit a couple of more all-time highs here, and the Qs also hit that. The Russell 2000 is still below that, but that's powering back as well. But anyway, this is where we are here. So in terms of levels, what we tend to look at are these levels of supply and demand. And because we're sitting at all-time highs, there are no supply zones overhead, so we only have demand underneath. But when we look at a couple of the other charts, I'll touch upon what a supply zone looks like. But for the moment, in terms of demand, what I'm looking at here, and I have to actually drop this to about a 30-minute chart here in order to sort of identify something here. So in terms of looking for a particular trading level here, really not in love with anything up here. This is just kind of sort of choppy back and forth kind of trading here. There's really nothing great here. And so we're really kind of waiting for a pullback until we get down to kind of this region right here. And right here, we can see very clearly that there was a drop, a consolidation, and then notice that price rockets out of this region here. That signifies an exhaustion of sellers. Right in here, there was, and as well as above here, there was a general agreement between buyers and sellers, and they were kind of shuffling shares back and forth within a relatively narrow range. But right down here, price comes down, consolidates, and then price rockets out of there. And then, of course, there's a big gap that then followed from that the following day. And in fact, this actually represents the NVIDIA gap from last week when NVIDIA announced its earnings, and that kind of juiced the market. And so we see that NVIDIA gap on numerous charts of all sorts. So, but that's what that gap represents there. So right here, this was an exhaustion of sellers here. And so if you think of the shares of if you think about the willing buyers, we can think of willing buyers and the shares that they want to buy as demand. And then, of course, willing sellers are more or less creating the supply of shares at a particular region. And so we can think of the willing sellers and their shares as supply. And so right here, supply and demand were in balance for this short amount of time. And then something happened here, some change of perception happened here. And essentially then the sellers effectively backed up the price chart because they were no longer willing to sell here anymore. And as a result, for these trades to happen, what happened, of course, was that the buyers ran up the price chart until they encountered willing sellers. And so that's how all of these trades occurred. Okay, and so right here, supply and demand were in balance, and then supply and demand then went out of balance. Okay, and all you were left here was where supply and demand were here. All of a sudden, right here, there was no longer supply. Consequently, what's left in its wake is referred to as a demand zone. Okay, and so in fact, that's what I kind of depict over here. And so what we were looking at here is essentially this pattern right here, where price came down here and then basically more or less consolidated, okay, and then rocket out of there. And so what we're waiting for is a retracement or a return back to this level, okay, and that's where we would actually be looking for a long trade or a bullish trade, okay. And so essentially this is the explanation here. It's an area of expected upward price pressure created by a period of brief consolidation, which I just showed you, and then there's a clear abrupt exhaustion of sellers, and then an energetic bullish move as the buyers ran up the price chart, okay. And so what we're expecting when price returns back to this region is we're expecting to see another, basically another pop out of this, okay. And we consider this to be an area of expected upward price pressure, okay, because they were either literally unfilled buy orders there, or if they're not literally unfilled buy orders there was just basically people wanted to, or institutions wanted to buy. It's just that there really wasn't any great opportunity to do so because there was the sudden exhaustion of sellers, okay. And so this is what we're waiting for when price returns to this region, that there conceivably would be another pop out of this. Now it's the origin of a gap, and I'm always telling people, people like to kind of buy at the origins of gaps, and if trading was that easy that you just found a massive gap, and then when price returned to it, that's where you buy. If that's all that the trading was, that would be pretty cool. But trading is not that. It's generally not that easy. So we're going to be looking at this as an area of interest, but we're going to be kind of cautious and kind of circumspect about it. We're not just going to kind of dive in with both feet, because again, this is a very obvious level. But we will certainly keep our eye on that. All right. So anyway, that's the SPY, and that's sitting at around basically between 493 and 495 or so. So we're keeping an eye on that. And in fact, if we look at the distance of where that is in relation to where we are now, oh, excuse me, forgive me here. For some reason the chart just went wiggy on me here. So let me fix that. Okay, so in terms of the where we are now in terms of distance, we're about 3.5% down. That's that 30-minute level that I was looking at before, and you can see it really doesn't look like a whole lot there. And then and of course one could also look at this level as kind of chunkier and using all of that, but essentially that's all preceding the NVIDIA gap here. And again, I don't think trading is that easy. That is just but again, we'll keep an eye on it. So in terms of where this level is here, though, that's 3.5% down of where we are now. We're sitting at 513 here, so we would need a pullback to about 495, and that's about 17 points down. So that's the kind of pullback we would need on the SPY in order to kind of execute a bullish trade here. All right, and the bullish trade, of course, would be either we could buy a call, or of course buy the stock itself. And then of course there's any number of other strategies that one could do here. One could also, of course, sell a bull put vertical spread as well, and that would be another way of expressing a trade at this demand zone here. All right, so that's the SPY. If we take a look at the Qs, okay, right down here again, it's a similar, very similar thing of what we were looking at on the SPY, unsurprisingly. So here's where we are now. Again, there's the NVIDIA gap. Right down here is essentially that more or less that same level that we were looking at on the SPYs, except now we see it on the Qs. So from where we closed today, that's approximately 4% down from where we are now. In here, there might be, there were some, little kind of, 10, 15-minute zones we can kind of find in there. But in terms of, quality, this is, kind of generally, we're generally preferring to find zones in terms of, reliability and consistency. We tend to like to look at these, kind of 1, 2 hour and even daily zones. So that's what we're looking at here. That's about 4% down. And then there's a 2-hour zone a little bit further down on the Qs. And so that's down here. and that's about 5.5% down. Also, I have this note over here, and I mentioned with respect to the Qs, you can actually, and also I didn't mention this before. The Qs, for those of you who don't know, the Qs are the ETF of the Nasdaq 100. Okay, so that's the Nasdaq. But one thing you can also do is, it's an expensive, it's an expensive share price, obviously $425. And of course, options are generally, relatively, depending on how you trade them. But if you're going to buy enough time and also buy them, let's say at the money or so, options on the Qs, of course, are going to be relatively expensive. Okay, but one can, if you look at the XLK, which is a sector ETF. If you look at the XLK, that's the tech sector ETF, and basically its chart more or less mirrors fairly closely the Qs. Okay, and today I believe the Qs, excuse me, the XLK, I believe that was selling at about 210 a share. So it's more or less half the price of the Qs. So if you're looking at a chart of the Qs and go, I would like to chart the Q, trade the Qs, but in fact it's a little too expensive for my taste, either with respect to the option or the share. Take a look at the XLK, because as I say here, the chart rhymes with the Qs. In other words, it's not the exact same chart, but it's general flow, it's general movement, and more or less the distance of where a level is with respect to current price. It's going to be pretty close to what the Qs are. So I'm generally a big fan, and we oftentimes steer our subscribers to trading the XLK rather than the Qs for the reason that I just said. All right. So at any rate, that's the story with the Qs. Now, if we move on to some popular stocks, and now we'll actually be able to look at some supply zones, because there are no supply zones here again, because we're sitting, on these indexes, we're sitting at all-time highs here. Okay. So, but in terms of some of these other stocks here now that I bring them up, you'll see that we can actually talk about some supply zones here. So here we are at Apple, okay, and so Apple, in fact, has interestingly enough, even though the Qs have been riding high, Apple has actually been kind of in the doldrums lately. All right, and so here's where we are right now. So in terms of a demand zone right below, okay, here is a demand zone right here. Price dropped here, consolidated, and then notice price. Then there's a very bullish candle here, and then that kind of starts that pop here. So right here again, a short amount of time sitting at this level, and then notice then price kind of rockets out of there and kind of zips out of here. So it's in here for a relatively short amount of time. And again, this represents an exhaustion of sellers that I just explained earlier. So when price returns here, we could then talk about expressing a bullish trade. So you can see we're almost back here. So obviously we have about another 1.5% to go or so, from about 179 and change down to about 176.5. So that's about a 1.5% move to get there. And then up here, price rallies here, consolidates, and then notice then price kind of then drops suddenly out of here. Again, this represents an exhaustion of buyers in this case. All right. So if we go back to the graphic that I just put together before, here's the narrative on the supply. We have an area of expected downward price pressure created by a brief consolidation in a range, and then a clear abrupt exhaustion of buyers. Okay. And so right here, price consolidated, and then notice price then kind of dropped suddenly. Right up here, something similar here. In fact, if we look at this in the daily chart, we can even see that, and it kind of cleans up a little, because in fact, this is really a daily zone right here off the daily chart. Price consolidates, then comes up suddenly, then notice now it consolidates, and then notice right here a very, very quick exhaustion of buyers here after a couple of days, and then price kind of drops suddenly from there. So this and for these trades to occur, obviously what happened was, in here, supply and demand, or willing buyers and willing sellers, they were in agreement for this 2 or 3 day period. And then right here, there was a sudden exhaustion of buyers, okay? And so for these trades to occur, this is the inverse of what I said a few minutes ago about the demand zone, okay? Essentially what happened was willing sellers had to run down the price chart until they encountered willing buyers, okay? And so what we're looking for here in terms of a trade, if we look at this zone here, which is another supply zone that was based though on a 2-hour chart. So if we go back to the 2-hour chart here, okay, where we would then be looking here is when price returned or retraced back to this level, we have the expectation that there is still downward price pressure in here, because all you have left here is supply, but no demand, okay? And so when price returns to an area where we anticipate that there is still further supply, and it's still it was an area of interest where institutions and retail traders wanted to sell, but didn't get the opportunity to do so except for a very brief period. When price returns to this region, we actually expect to see another drop, another downward push from this level. Okay, and price has not been back here since, and so we also consider this to be a fresh level. Okay, so when price returns there, this is where we would express a bearish trade. And so this is what we talk about when we talk about expressing a bearish trade from a supply zone. We can either sell the stock, in other words, short it. So we designate that minus S. We could also, of course, buy a put designated by plus P, and then of course we could also do a bear put vertical spread, which essentially is buying a put and then selling another put underneath. That reduces the premium and also makes it a gentler, less responsive trade, because you have the delta, of course, offsets the delta of the long put that you buy. So you have a gentler trade, but also a trade that's less affected by time decay. So essentially, it just becomes like I said, a gentler trade than simply buying a put. And then, of course, one could also sell a bear call vertical spread in order to collect premium. Okay, but all of these are bearish scenarios, and they are all done from the supply zone. So those are 4 simple ways of expressing a bearish trade from a supply zone. And of course, there are numerous other option strategies that have a bearish bias that one could also do. But these are the most basic ones. All right. So for Apple, we expecting, again, this is where we would express a bearish trade up here, and then down here, here's a demand zone on Apple, and then we just went through that, and so this is where, of course, we would express a bullish trade. Okay, and that's about 5% down, or excuse me, 1% down from where we are here, and then up here, we would obviously need a significant push up here to get there. But those are the levels that we're looking at on Apple. We take a look at Google. Okay, so here's where we are on Google here. So here's where we closed here. So you can see a little less than 5% up. Right now we're sitting at 138. We would be looking for this thing to get up to about 144, and then that's where we would express a bearish trade up here. Okay, and so this kind of shows up here nicely in the 2-hour chart. It's probably actually there also in the daily, but in terms of looking for the candle structure of what we want to see, this kind of more resembles a pivot, and nothing wrong with that per se. But we, in terms of identifying and qualifying this level, there's a certain candle structure that we want to see in here, and this more or less kind of meets the criteria once we drop it down and use a slightly finer time frame. So using the 2-hour chart here. So that's about 4.5% up here on Google, and then 3% below is this little area right there where there's a rally, a base, and then notice then price rockets out of there. Again, it's in there for a relatively small amount of time. This is really more or less like kind of one trading day that's in there. And then all of a sudden there was this exhaustion of sellers here. And again, we went through the narrative before that when price returns there, All that's left here is demand, because the supply essentially disappeared here. And so when price returns here, we're expecting that there is still some residual upward price pressure that's waiting to be tapped here. And so at that point, then we'd be looking for a bounce at around 130, 133 and change area. Okay, so that's Google. We take a quick look at Amazon. Okay, so here's where we are on Amazon here. Again, here's where we closed. Right here, we had a drop, a base, and then notice again, it's in there for a relatively short amount of time. And then notice that string of green candles here, most of which are either very bullish or at least somewhat bullish, closing near the top of their range. So that indicates that there was a lot of energy that where it came out of here. It didn't just drift out of here, but it came out of here with a great deal of energy, and so that helps to qualify a demand zone there. So it's not only that we want to see it come out of the level, but we want to see it again come out with a great deal of energy, and that consists of both gaps as well as larger, very bullish candles. Okay, so that's the deal with Amazon. So this demand zone here is about 2.5% down, and then above there's about an area of about 3% above. But this is actually not an area of fresh demand. This is an area at this point of tested. Excuse me. This is an area of, this is not supply, but this is an area of tested supply, and we can almost think of this at this point as resistance. And if we go back in time here. This was an area, this was a zone that got initially created right here, and this goes back. And if we look at this in the daily chart, it kind of shows up a little better. But this is July of 21, and of course, if we think back to July of 21, we were about a little less than a year and a half into COVID, which kind of came to the fore around February and March of 2020. And so this level right here kind of represented that peak that Amazon hit at the time, where basically everybody was more or less kind of buying online. You know, everyone was working from home. Everyone was using Zoom and all these cloud services. And of course, Amazon ruled the roost in terms of people buying from home. And so its share price obviously rocketed in that 15 or 16 months as everyone was buying from home and everyone was kind of locked down. And so here's that little note I have. This is this level here, which was tested 2 or 3 times since. This was the culmination of the massive online COVID buying. So we've not, well, now here's, so now if we go back, okay, we've not been back there since, okay? And so this thing is going to be coming up there again, probably relatively soon, assuming the broad market kind of holds together here. It's going to be coming up there again. Now, in terms of trading, we're not going to necessarily just be racing to short from there, because the way we look at it, every time a supply zone gets hit, some of the supply gets chewed up. And so as a result, when price comes back there for the 3rd or 4th time, we're not necessarily confident that there is going to be all this downward price pressure that's just waiting to be tapped. But we'll certainly keep an eye on it, though. So that's about 3% up. And what would happen is we would wait for price to sort of drill into this zone, and we would be waiting for some kind of sign in a lower time frame that it's actually showing signs of reversing and then coming and then starting to drop. And if we, you know, if we then saw kind of a very energetic, let's say 1 hour candle, and it kind of really kind of, you know, shot down, you know, we might be convinced then to then short from this region. But we wouldn't just take it as an article of faith that we're going to short out of here, because of the fact that this is not a fresh level anymore. All right, so that's the story with Amazon. So we're about 2.5% down there, and about 3% down, 3% up from where we are now. All right, so let's take a quick look at Netflix. We'll conclude here. So on Netflix here, we have a demand zone here. We're about about 5% down here. So this is actually a fairly long distance here. And in fact, I should have updated this, because in fact, I actually like this level actually here as well. And in fact, that's actually going to be closer to where we are here. So if I throw those lines in here quickly, Okay, and again, this is an area of we can see price consolidated. Okay, came down, consolidated, and then bounced from there. Okay, so this is a brief area of consolidation. So this is actually a demand zone that is formed right here. So in fact, we would actually be looking perhaps to actually go long and express a bullish trade out of here. And so that's about 3% down from where we closed here. And then if we go back and we go back in time, and we go back. So right here, price rallied here, consolidated, and then of course notice then a relatively bullish, bearish candle here, and then that kind of then starts that kind of precipitous drop here from about 625 or so, 627, and that got down to about 58 in the 580s or so. So that's about a $40 drop on that, which represents about what is that, about a 6% move or so. So that's a pretty healthy drop there. So if in fact if when price returns to this region, okay, you can see it's kind of pushing up there with a great deal of energy here. So we'll wait to see what happens here. You know, we'll be looking for price to kind of get stuck in there, or at least stop by this and then turned around. And if we see a sign that in a smaller time frame chart that we're actually starting to get a bearish move here, then again we'll go back and actually formulate and express a bearish trade. And as I explained, you can either short the stock or at its simplest kind of buy a put out of there. And then generally when we buy a put, you know, you want to buy enough time. So, you know, have 3 or 4 months, even though you're not going to be in the trade that long, you want to buy enough time so that if you do get stuck in a trade for, let's say, a week or two or even longer, you want to make sure that you're not get too beaten up by time decay. So as a result, we tend to be value shoppers when we buy long calls and long puts for that reason. All right. So at any rate, that is what I got. So I hope you found this interesting and informative. Again, you know, here's the rundown on these demand zones again and supply zones. Again, it's basically they just represent these areas of consolidation where there's an exhaustion of either buyers or sellers, depending on which one we're looking at here. And then there's the expectation when price returns to that region, we can then execute trades when price returns when price returns to those zones. And in particular, you know, these are useful in terms of both creating high probability controlled risk stock trades, and they're also awesome for having good entries on options trades. And if you click on the link in our YouTube page here, you could set up a call, and I would be happy to talk to you a little bit more about this whole supply and demand concepts, and also analyze a chart. If you have a symbol or two of interest, I'd be happy to go through that as well. So at any rate, that's what I got. This is Mitch Firestone with Precision Trading Labs. Thank you very much for the privilege of your time, and I will see you next time. Take care. Bye-bye.